After completing now the three financial statements, that is income statement, balance sheet, cash flow statements, and even the supporting schedules, the next thing we need to do for us to be able to carry out the forecast, we need to get the assumptions and drive for the last 2 years and the current year, because this is the information which this particular company will be using, or they use to get these particular values. So for us to see whether they are on track or they just guess those particular values, we need to get the assumptions and drive for the past 2 years and the current year. So we can't get the sale year of growth for the year 2010 because we don't know the revenue for the year 2009, but we are able to get the one for 2011. That one we are going to get by dividing the one for year 2011 by 2010, then we subtract 1 because we just want to get the growth. So the growth there for the year 2011 was 6.5. We fill that right and we get that. The one for the year 2012 was 7.4. So as you can see, this particular company is predicting that in the next 3 years their sales will be growing by 6.9. Then we have the gross margin. The gross margin, this is the percentage of gross profit on revenue. So we're just going to get that from this as a percentage of this. So for the year 2010, we can see that the gross margin was 53.2%. Just going to fill that right and we get the one for 2011 and 2012. And as you can see, this particular company is predicting that in the next 3 years their gross margin will be 55.7. Then we have the depreciation. The depreciation for the year 2010, we are told that depreciation is the percentage of revenue. So we are going to have depreciation, this one, as a percentage of revenue, and we get that. So when we fill that across, we can see that the company is predicting that in the next 3 years their depreciation will be 3.3. Then we also have general administrative expenses. You can also call it SG&A. Selling general administration expenses is also a percentage of growth of revenue. This is the, you put it positive, then you get it the percentage of revenue. So we can see that it is we can fill that right to get this SG&A across the 3 years. Then we have also the marketing and promotion expenses. This one we are told that it is a fixed cost, it is not a percentage of anything. So we are just going to take this value the way it is. So it is a fixed cost. Yes. So other operating expenses, it is also the other operating expenses is a percentage of revenue. So we are going to take it as a percentage of revenue and we are going to get that. So that one goes like that. Then we have long-term debt interest. as an average, as a percentage of average debt, long-term debt interest, this is the interest here, then as a percentage of average debt. So average debt, we get it from the liability, that is this one here. So we get that to be 6.2%. And they also predict that their long-term debt interest will be at 6.2% of the average debt. Then we also have the tax rate. Tax rate is a rate of a percentage of income before taxes. So we are going to the income statement when we get the taxes as an average of income before taxes, and we get that. When we fill that right, we can see that in the year 2010 the taxes were 34.7% of the income before taxes, and they also assume that in the next 3 years their taxes will be 24.8%. So we have filled the assumptions and drive for the income statement, and we're now going to do the one for balance sheet, and we are going to get the one for capital asset turnover ratio. This is the ratio between capital assets and revenue. So we're just going to get that, divide by, we come to the balance sheet, we get that. So we see that the capital asset turnover ratio is 4.23, and when we fill that right, we can see that. Then receivable days, we are going to get this by dividing account receivables by revenue, then we multiply it by the number of days in a year. So the receivable days for this particular company in the year 2010 was 57 days. So those are the number of days their customers will take to pay their. Then we have the inventory days. The inventory days, we are going to get the inventory divided by cost of goods sold. Then we multiply that by the number of days in a year. Then we get the number of the inventory days. We're going to fill that right. Yes. Then we also have account payable, the number of days they take before they pay their account, they settle their account payable. That one is going to be account payable divided by cost of goods sold times the number of days in a year. Put that positive. We are going to do that. Then we have other current liabilities. These ones are, it's a percentage of revenue. So other current liability is here. What is their percentage of revenue? We see it is a 1.3%. Then we fill that right. Then we have the long-term debt. Long-term debt, we get this directly from the balance sheet. and we feel that right to get it right. So this company, as you can see, they predict that they will be able to add more debt in the next 3 years. Then we have the common share capital. What is the common share capital? We get that from the balance sheet. We get this. Then the dividends payout ratio. The dividends payout ratio, this one you are going to get it as a ratio of dividends paid against the net income. You can just divide that directly and get that in the year 2010 the dividend payout ratio was 83.2%. As we can see, it reduces across, and they predict that in the next 3 years they will be able to, the dividends payout ratio will be 57.5%. So from there we have completed our assumptions and drives, and we'll now be able to continue with our forecast.